The retirement plan most people are building right now is not a plan. It is a hope dressed up in a spreadsheet. A collection of positions accumulated over years of half decisions, forum recommendations, and the vague intention to sort it all out properly sometime before 65. And the reason most people who want to retire early will not, despite saving consistently, despite investing regularly, despite doing most of what they were told to do, is not that they picked the wrong stocks. It is that they never replaced the paycheck. They built a portfolio. They never built a machine. Here is the number that determines everything, and that almost nobody calculates correctly before they make the decision to stop working. Your FIRE number, the total portfolio value required to sustain your lifestyle indefinitely, is not simply 25 times your annual expenses, which is what the traditional 4% withdrawal rule produces. That rule was derived from historical data using specific market return and inflation assumptions. Assumptions that the 2026 environment has broken in both directions simultaneously. Sequence of returns, risk alone, the specific danger of experiencing a major market drawdown in the early years of retirement, when the portfolio is at its largest and the withdrawals are beginning, has made the 4% rule a genuinely dangerous framework. The real number, adjusted for current inflation and volatility, and a retirement timeline extending 40 or 50 years, is closer to 30 to 33 times annual expenses for early retirees. That gap is not a minor adjustment. On a $50,000 annual lifestyle, it is the difference between a $1,250,000 target and a $1,650,000 target. $400,000 of additional required capital that the standard early retirement conversation almost never accounts for. But here is the deeper problem with how most people think about early retirement portfolios. And this is the assumption that quietly derails plans. The 4% withdrawal rule requires you to sell assets to generate income. Every year, you are liquidating a percentage of your portfolio, which means your ability to sustain yourself is entirely dependent on the sequence and timing of market returns. If the market decides to deliver its worst years in the first decade, you will be selling depreciated assets when you most need the portfolio to recover. You are not managing an income machine. You are managing a slow, unpredictable liquidation with a 30-year runway and no margin for bad timing. The three-fund dividend structure solves this at the architectural level rather than the mathematical one. Instead of building a portfolio you sell from, you build a portfolio that pays you three specific positions generating reliable income. It covers your lifestyle expenses from cash flow rather than asset liquidation. The portfolio value becomes almost irrelevant. The first pillar is global equity income, a diversified position across international dividend-paying equities. The specific function of this pillar is growth, not maximum growth. Dividend growth, the consistent expansion of the income stream. This keeps pace with and ideally outpaces the inflation that erodes the purchasing power of a fixed income structure. A yield that stays flat at 5% is not a 5% real return across 4 decades of inflation. It is a declining real return. The global equity pillar is the engine that prevents that decline by building income growth into the structure from day one. The second pillar is stable fixed income, bonds or stable income instruments generating predictable, low volatility cash flow. The function is not yield maximization, it is the buffer, the position that continues generating income during equity market pressure. Every serious income structure needs an asset that pays you while everything else is going down. Fixed income is the part that keeps the income arriving. The third pillar is high dividend trusts, REITs, BDCs, and infrastructure trusts distributing high current income. This is the yield engine, the pillar that generates the income density required to actually replace a full paycheck from a portfolio of realistic size. The high dividend trust component, yielding 7 to 10%, is what makes the total blended portfolio yield sufficient to cover real lifestyle costs. Three pillars working together produce something none of them can produce independently. Growth from equity prevents inflation erosion. Stability from fixed income ensures continuity during market stress. Yield density from trusts makes the structure practically sufficient. The blended result is a portfolio generating 5 to 7% in total annual income across a diversified, self-reinforcing structure. With the income growing annually, buffered from volatility, and made sufficient from day one. Here is what this looks like. At a blended yield of 6% on a portfolio of $1,650,000, the annual income is $99,000. At 5% blended yield on the same portfolio, it is $82,500. These are not withdrawal amounts drawn down from a shrinking base. These are recurring income streams generated by the portfolio without requiring the sale of a single share. The portfolio itself remains intact. The reason most scattered portfolio approaches fail is not that the individual investments are poor. It is that uncoordinated positions do not create a paycheck replacement. They create a collection of assets generating sporadic income at unpredictable times that requires active management. A three-pillar structure with deliberate yield complementarity and role assignment is not more complicated. It is less complicated. Every position has a defined function, and the structure as a whole generates reliable monthly income without requiring ongoing intervention. The math of early retirement in 2026 is more demanding than the standard framework suggests. The inflation adjustment to the FIRE number is real. The sequence of returns risk for 40 and 50-year retirements is real. The inadequacy of asset liquidation as a primary mechanism is real. But the solution to each of these problems is the same. Replace the withdrawal with income. Build the machine instead of the portfolio. And build it from three specific pillars that together produce something none of them produces alone. Sufficient, growing, durable income that arrives every single month whether the market cooperates or not. That is what retirement actually requires. Not the number, the machine.